Hello everyone, my name is Carter and I'm going to tell you about the DCM investment style. So the biggest thing in our DCM investment style is our Christian perspective. And we have 5 major tenets in our Christian perspective that we try and focus on when we're investing. 5 major things are prudence, patience, and then honesty, stewardship, and service. So the biggest thing for our prudence is avoiding risks that the market does not reward. It is not Christian to try and jump into things without knowing the risk, and we need to know the risk, therefore we can gauge whether it's worth it to go for the reward or not. Patience is very important because the stock market consistently returns gains to compensate investors. In any 5-year period, the stock market has never had a loss, and in any 10-year period, it's always a gain. And then for honesty, stewardship, and service, these all kind of go together. They kind of count as quote unquote 3 legs of a stool. Um, and this stool kind of holds up the rules rather than exceptions and analysis, and then the fact that our trust drives our financial decisions. We need to figure out if we have trust in certain companies and their financial statements, and we need to understand that rules are important in analysis rather than exceptions, because then we can try and focus our stocks for growth versus just kind of like not doing well for us. So kind of jumping into the things we invest in, we mostly invest in securities, and then a couple of different places that we invest them in, or if they're in the S&P 500, the Dow Jones Industrial Average, the Russell 1000 Index. And then the other 2 things that we kind of focus on is that the company must be one of the 5 largest in their sector, and if that's not realistic, then it just has to be in the top 50% of their sector. We like to invest in bigger companies because they have more stable growth versus like smaller cap, just growth companies. To kind of talk about our comparison, we always kind of gauge it off we gauge our portfolio growth off the S&P 500 growth. So what we try and do is we look at the S&P 500 weight in stocks, and we try to match that in all their sectors in our DCM portfolio. So like real estate, infotech, utilities, we try and manage their weights along with the S&P 500, and then we take the success or not success of the S&P 500, and then we gauge that with the DCM portfolio to see how we're doing compared to the market. We always want to try and up the market in each quarter. Kind of discussing risk and reward. It's important to understand that when you're investing, risk taking is necessary and important, but must be done stewardly, and that risks are taken in activities that contribute to human flourishing. These are both very important things because risk taking needs to be like, we need to do it correctly. We can't do it like foolishly. We need to understand that we're trying to kind of make money. We're not trying to like make money hand over fist. Like we need to understand that making money is important, but having the risk of losing a lot on one thing is just very unstewardly. DCM has kind of more of a long-term focus on growth and income versus being super risky, which is what I was discussing. This allows the club to be managed passively by itself for long periods, mainly for breaks. So like spring break isn't quite as long, but like Christmas break is almost a month. Summer break is almost 3 months. And we need to understand that we need to make sure that we have good enough companies that it can manage itself passively, unless for some reason we have to have like a very important meeting over the summer just to kind of gauge companies that are not doing well and need to be sold. So another main thing that DCM checks out is the moral and ethical review of companies. We need to make sure that the companies that we invest in align with our moral and ethical beliefs, and we need to conduct screenings and analysis for these companies to allow for better decisions qualitatively and quantitatively. This is very important for the DCM like portfolio because like we've had issues in the past of companies that make poor decisions where we're like we'll take a meeting and we'll kind of discuss, do we want to stay in this company, do we want to get rid of it, and then we need to figure out whether we want to get rid of it or keep it. And then quite often if a company is brought up that no one feels like is correct, then it won't even make it to the meetings, and it'll just get tossed out kind of in preliminary discussions. Like these would include like companies that base off like tobacco, alcohol, etc., or companies that just make poor decisions overall. So another thing that DCM looks at is value stocks versus growth stocks. We kind of like to primarily invest in value stocks because value stocks are generally less speculative. DCM is not opposed to growth stocks, but they must be reliable. Like growth stocks, we can use them, but if they fluctuate so much that it's super unpredictable, then we would not want to be in them because our reward must be proportional to the risk. Value stocks just kind of work out better for us because if you invest in a value stock correctly, it'll grow. But the investing in growth stocks kind of takes more things of like timing the market. We do not want to try to time the market because that is an unchristian way to invest. And then another thing I have for you guys is the USA versus international companies. We like to primarily invest in domestic companies. This allows for better company exposure because we can trust the financial statements that are given from domestic companies versus international companies. Because international companies do sometimes like to kind of change their records if at all possible to make their company look better and get better investors. It has happened in the past. And we try to avoid it. The only downside is that the market may be too saturated, and many people may see what's going on before we know what's going on, which is why sometimes we invest in international companies. They might not be as transparent with their financial statements, but they're not noticed as quickly by U.S. investors. This is important because sometimes we can make a little bit of money on that by investing at the right time versus getting in there a little bit late to the game, and then U.S. investors have kind of already taken stock up a little bit. And then another thing that we kind of focus on is that only 15% of our portfolio should be made of international companies at a time. And this 15% also includes like other like small mid cap growth companies versus value stocks. And this 15% is kind of like the lower part of our portfolio where we try to make a little bit more money, but we kind of try to keep that other 85% like good domestic companies that keep growing value. And the last thing I have to talk about is the analysis. So we focus on technical and fundamental analysis. Our technical analysis is slightly avoided due to temptation to time the market, and it can be counterproductive and it can exacerbate market swings, which is why we kind of avoid technical analysis. So we try to move toward a fundamental analysis. This lets us understand how companies are compared to their realistic value, because companies' realistic value and their market value can be two totally separate things. And then fundamental analysis helps make the market more efficient, and it is a real service to investors, and it actually increases the value of stock versus exacerbating the swings like the technical. We try to avoid technical analysis and try to focus on fundamental analysis. Thanks for listening, and I hope you guys learned something.